welcome back to Blended Academy. This marks our second lesson, and in today's lesson we'll be doing owner's equity for company. So I'm going to show you the difference between owner's equity for sole trader and owner's equity for companies, because in our first video we spoke about owner's equity, but that was on the side of the sole proprietor or the side of the sole trader. So in this lesson we're going to focus more on owner's equity for company. So for sole trader, we say that, okay, fine, we've got our assets, we've got our liability, and we've got our owner's equity. So remember, a sole proprietor or a sole trader is owned by one person, which means that there's one person who is owning a business. In that case, it was a clothing company. It was not company, but it was a clothing business, which was called ABC Clothing. So the truth is that this ABC Clothing, or this person, has got assets. Yes, they've got their liability, but when it comes to owner's equity, that's where there's a difference between a sole trader and a company. So for a sole trader, we're saying that, okay, fine, a sole trader has got expenses. They also have income. There's what we call drawings, and there's also what we call capital. So we're saying, okay, fine, expenses is what the business or the sole trader has incurred. It's what has to be deducted from their profits or from their income. Income is what is coming into the business, and drawing is when a person or the sole trader in this case takes money from the business pocket. In other words, they take money for own use, for their own personal use. And capital is the money that this person has contributed or has taken out to start this business, this ABC Clothing. So now this is what owner's equity for sole trader is made up of. This is the owner's equity for sole trader. Remember, it's one person, therefore the income is going to one person, the net profit is going to one person. So this actually illustrates our net profit. This affects our net profit. So we're saying that, okay, fine, after all this deduction and after all this income, this person is going to own this certain amount of money. So we say that expenses in this case, they increase on the debit side and decrease on the credit side, income vice versa. And then for drawings, we say that they increase on the debit side and decrease on the credit side. And for capital, they decrease on the debit side and increase on the credit side. It's okay, fine. So that was just a summary of what we did in lesson 1. So now we're moving to lesson 2. Here we're talking about companies. So in companies, we're saying that, okay, fine, now there's a new business, there's a new company. In this case, let's say this is a construction company. And I feel like everybody now understands that a company needs money to run its normal day-to-day business. So now in this way, we do not make money in the form of capital of one person giving the company money. So in this point, or in this type of a business, we're saying that, okay, fine, now the business is going to issue shares. If it needs money, it's going to issue shares, and the people who get or who buys these shares are called shareholders. So it's issuing shares to shareholders, and then we're saying that this is shareholder 1, shareholder 2, shareholder 3. So, okay, fine, it has issued 100,000 shares to these shareholders. For this one owns, let's say, 20%, this one 35%, this one 45% of this 100,000. So now what happens is that when these shareholders obtain ordinary shares from a business, they give in money. So this is an inflow to the business. This money is used by the business to run its normal day-to-day business, to start its business, and to do whatever that a business needs to do. So this inflow of cash to the business comes in the form of bank, in the form of money. Remember, there was an outflow of cash, and then there's inflow of money in the form of a bank. So this goes back to saying that, okay, fine, a transaction needs to affect two elements, two or more elements. So in this case, it's ordinary shares, and then it's bank. So fine, okay, fine. Now we're saying that, fine, these shareholders own a certain percentage of this company. And what happens? The advantages to this shareholder is that they receive what we call dividends. So now dividends is received 2 times. There's an interim dividends, and there's a final dividend. So now this interim dividends is received by shareholder at the middle of the year, after 6 months, and the final one is received at the end of the year. So shareholders receive 2 dividends in 1 year of assessment, and that's the advantage to shareholder, the fact that they receive dividends. So now we're moving back. Now we're moving back to retained earnings. Here we're talking about ordinary share capital. This is ordinary share capital. So now we're moving back to another portion of owner's equity for company, which is retained earnings. So retained earning is actually what we did here. What we did here is retained earning. Is the earning that the business or the person, the sole trader, has at the end of the year after reducing the expenses and adding the income and reducing the drawings and then adding the capital. So here we're saying, okay, fine. Let's say this person has a balance at the beginning of the year of 10,000. Fine. So we're going to add our net profit. Remember, net profit is our profit after every deduction, after all the expenses, after all the income tax. So we're saying that, okay, fine, this person has got a net profit of let's say 100,000 in this case. Fine. So now there's something that's called a shares bought back. Here we're saying that, okay, fine, maybe one of these shareholders decide then to sell their shares. Maybe they have one of the shareholders died, and now the shares has to be sold back to the company or sold to someone else, and then now the company decides to buy back those shares. So what happens here is that the company gives money then to this person in the form of bank, and then this person gives back those shares to the company. So now there's a reduction in the number of shares that was issued by the company of the amount that was bought back. So if we're saying that, okay, fine, maybe this person 3 owned 45%, which is 45,000 shares. And now they're selling all these 45,000 shares back to the company, which means now the shares are going back to the company, 45,000, which is a decrease in the number of shares which were issued, which is the decrease in this 100,000. So now the business, then we're going to say that, okay, fine, we're going to reduce this ordinary shares that we have issued by 45,000, which has been bought back. So now the business, we're saying that it's going to have an outflow of money to this shareholder and an inflow of cash from this shareholder. So think of shares as maybe this pen. I'm saying that I'm giving you this pen. So now when I need this pen, you're going to give me this pen, and then I'm going to give you money. You bought it from me. Now I'm giving it to you because you bought it from me, and then you're giving me money. But now when I want to buy it back, you're going to sell it back to me. I take the shares, I take the pen back, and then I give you back your money, and with an increase probably. And so we're saying we're fine. So there was a repurchase or shares bought back, repurchase of shares. This is a deduction because now there's an outflow of money from the bank. Now the shares issued are decreasing to now there's going to be 55,000 shares issued, which is going to be distributed among these two shareholders. So now we're saying, okay, fine. Now we will repurchase shares. Let's say we repurchase them for 20,000. Okay, yeah, let's just say 20,000. That's not a realistic amount of money, but yeah, let's say that we bought them back for 20,000. So okay, fine. This was an outflow of money. In other words, out of the net profit that the company had, it also went to a point wherein it has also reduced its net profit by 20,000 because this is an outflow of money. So now another outflow of money that affects our retained earnings is our dividends. So remember, we said that there's an interim dividends and final dividends. The company paid interim dividends and final dividends to its shareholders. Let's say 15,000 and 10,000, and this adds up to 25,000, which is an outflow of money. So this is also an outflow of money. So now we're going to have our balance at the end. This is the net profit plus the balance at the beginning that we had minus all the expense, all other payments that the business made to its shareholders, which means that it repurchased the shares from the old shareholder and also paid dividends to the current shareholder, the shareholder that it has. So now we're going to have our balance. So the remaining of this deduction is called balance at the end. This is the balance at the end. This is the retained earning. So we're going to add this minus this 2, and then it's going to give us a certain amount. So now this amount here is the one that goes to our owner's equity. This is what the business holds after it has paid all its expenses, after it has paid all its dividends, after it has paid the shares that were repurchased. And then the ordinary shares also goes to our owner's equity, because this is what shareholders hold. Remember, ordinary shares has to do with shareholders, the value of the company. So this is what it has, and then this is also what it has. But then here we didn't do calculations, so you're gonna see them in our next lesson. So thank you so much for tuning in, guys. I hope this was very informative and it has cleared all your questions in your mind. So please don't forget to like this video, comment, share, and subscribe. See you later.